Good morning, everybody. Welcome to October's Elevánt Insights. Happy to have you on board. Exciting topic, that of taxes. Before we get into that, just want to kind of make a note of where we are in the year. October 15th has a lot of important dates for people that you may or may not be aware of. Today is the extension of your tax deadline, so hopefully you got that done. If not, you've got about 12 hours to get that accomplished. Also, those that are 65 or older, today is the beginning of the Medicare open enrollment period. And so we would recommend, as a general review, to look at those at least every 2 years to make sure that you're in the right area for your Medicare, and find that expert that you like to work with and review those to make sure that your prescription drugs are being taken care of, and all the things that you need. More in line with our neck of the world is that yesterday was the second anniversary of the bull market. So after COVID, we've had some great expansion, and out of the last 16 years where we've had a bull market for 2 years, 12 of 16 we've gone on for a third. So at this point, there's nothing really that would say we're not going to have another positive market going forward with that. But in the meantime, Brian and I are going to spend a few minutes with you today to discuss things that you need to really focus on for the next 90 days approximately, as you do things this year for your taxes that hopefully will help you with that and reduce those as much as possible. So Brian, if you go ahead and take control and open up the PowerPoint you put together. We're each just going to take a few minutes and cover a few points. The first one that I wanted to mention is to make sure that you're maximizing your retirement plan. So if all you're contributing to is an IRA, make sure that you're taking care of that. So for 2024, you can contribute $7,000. If you're over the age of 1,000, you can do another. I'm sorry, over the age of 1,000. That'd be good. Over the age of 50, you have the catch-up provision, and so you can do an additional 1,000. If you're part of an employer plan, a simple IRA, the maximum contribution there is 16,000, and the catch-up provision is 3,500. On a traditional traditional 401k is 23,000, and the catch-up is 7,500. So again, make sure that you're maximizing those retirement contributions. That's going to help offset your taxes if you're in a pre-tax type of plan. The maximum for a Roth IRA is 7,000 for the regular amount, and an additional 1,000 for the catch-up. Another thing, as I was preparing, that I hadn't thought of for a while, but it's a good time this part of the year to look at your withholdings. So check with your employer, your human resource people, and make sure that if you're going to get bonuses or whatever, that you may need to increase or decrease the number of exemptions that you're having withheld. If every year you're having a large refund, you may want to consider having more or a smaller amount of taxes withheld. If you're not having enough, then you want to have more. So this time of year is a good time to go back, look at that, maybe review last year's taxes. It's always better for you to have the money than for the government to have your money. The next thing that I wanted to take a look at would be educational related expenses. There are some of those that qualify for educational credits, one in a lifetime types of things. And if you are, I would just say if you're in the position where you are helping pay for your own expenses, educational expenses, or somebody else's, you can make contributions directly to the institution as one way, but there are some tax credits and other benefits that are available under current tax code. And take the time to chat with your tax professional to find out if you qualify for one of those before year end. And that kind of takes us to the next educational thing that most people understand and are familiar with, and that's the 529 plan. Brian, you want to take over on that?
Yeah, you bet. Appreciate you guys bearing with us here. We thought it'd just be best to just rapid fire, give you some quick tax tips, things to remember coming into the end of the year. So just to recap what Dan's talked about so far, max fund your retirement plan contributions, double check your withholdings, see if there's any educational expenses you can take advantage of. So we'll, again, kind of recap so that you guys can take good notes. And some of these may apply to you, some of them may not. Obviously, none of these are considered tax advice for you, more just coming up with some ideas that you may want to consider before the end of the year. Well, thanks, Dan. 529 college savings plans. So this comes into our tax environment mostly in the area of contributing to your own state's plan. So if you live in the state of Idaho and you want to contribute to Idaho's plan, there is a state tax deduction for those contributions. So as a reminder, 529 college savings, typically there's a beneficiary, likely it's a child or a grandchild, that would eventually take advantage of tax-free growth that can be used for college education expenses. Now, 529s have become quite open in relation to what qualifies as an educational expense. You know, we can be in the 4-year university world, we can be in the 2-year college world, we can be in trade school, beauty school, you know, just about any higher education qualifies nowadays, even private school for K through 12. Another neat provision that's changed recently with 529s is, let's say you don't use that money for those kids. Maybe they get scholarships, maybe they pay their way, and you have money left over. Well, if that account has been in existence for 15 years, you can actually convert that in the name of the beneficiary or the child to a Roth IRA and let it keep growing tax-free for their retirement, which is pretty cool. So you can only do that up to $35,000 per lifetime, but it's a great opportunity to take advantage of tax-free growth for college and then tax-free growth for retirement for those children long-term. So pretty cool opportunities. And again, if you use Idaho's plan, if you live in Idaho, you'd get a state tax deduction for that. Not a federal tax deduction, but you'd get a state tax deduction. So idsaves.org. So Idaho or idsaves.org is where you'd go to check that out.
Hey, Brian, one quick question on the 529 plans. What's the amount that somebody, if they're doing some estate planning, can contribute into a 529 plan?
Great question. So 529s have kind of a 5-year accelerant on annual gifting. So you can really go nuts and doing just about as much as you want into this. If you're a grandparent wanting to gift in the name of college for your grandchildren, you can do quite a bit. If I remember right, the annual gifting limit for 2024 is 18,000. Does that sound right to you, Dan?
Yes, so that's correct.
Essentially, you could do 18,000 times 5 as a max funded 529 college savings for a grandchild. And you could do that for each grandchild if you wanted to, which is pretty neat. So the neat thing about that is you could even do that for you, and a spouse could do that for each grandchild. So really the limit is very, very high. Now the state tax deduction has a limit, but the contribution amount you can do quite a bit, so which is pretty neat. All right, let's jump into HSAs, or health savings accounts. So health savings accounts are to medical expenses as 529 accounts are to education. So very similar. So you can put money in. There are some tax deductions that you can get federally as long as you have a qualified HSA plan. So the qualified HSA plan means it's a high deductible plan that allows you to contribute to an HSA and get some tax deductions, usually up to a max amount of $8,000 or so. I think it's 8,200 or something right in
Yeah,
there.
I just pulled it up for you, Brian, here. Single amount, so if it's just an individual, it's 4,150, and a family is 8,300. And it also does have the age 55 catch-up provision.
Perfect. So HSAs are a wonderful asset. Certainly in retirement, will benefit from having some money set aside for medical and medical expenses. So HSAs are a great thing to look at. All right, next one, maximize business and personal related expenses. Now, I'm never a huge fan of front loading expenses or even creating expenses for the benefit of tax deductions. However, if you're planning to do something anyway, buy a vehicle, buy a truck, buy a tractor, whatever it might be, if you already are in the market for those things and you're planning on doing it anyway, then I would consider, does it make more sense for that deduction to happen in this calendar year or next calendar year? If you're a business owner or a farmer rancher, you might be able to squint into next year and consider maybe this next year will be a higher tax year for a number of reasons. Maybe I push it to next year, or maybe we bring it back to this year. So just getting intentional about some of those expenses as to whether we want those to be for this calendar year or next calendar year. Now, I wanted to bring up personal expenses as well, because not everybody owns a business. And so I want you to consider some of the things that are deductible in the event that you're itemizing on your personal expenses. And so one of those would be your mortgage interest expense. And so one thing you can do on your mortgage interest expense is pay a 13th mortgage payment. Okay, so if you have it set up on a monthly payment schedule where you've paid on each month of the year, well, if you went to on the end of December and made your January 2025 mortgage payment in 2024, at the end of December in 2024, you would get a 13th month of interest expense that you could reduce your taxes with. Now, the downside is that now you'd only have 11 payments for next year, unless you did it again the 12th month, and then you'd just be back on the 12-month schedule. But again, this is another arrow you have in the quiver if for some reason you have a higher tax season this year and you really are looking for all the expenses you can get. So it's a very easy thing to do to get a little more expense on the personal side.
Question for you, Brian. So would that be the same if I'm making an extra $500 a month payment each month, or is it just on the 13th payment in December?
Great question. So this would not be your principal payment that you're deducting, right? This is the 13th payment of interest that you're deducting. So when you get that document from your mortgage company that tells you the interest that you paid and your primary residence, that interest is deductible. And that's what we're talking about. So we want to make your real 13th month payment, the one that's, your real payment that's due in January, make it in December and pay the interest in December. So if you're just adding another principal payment to your mortgage, that's not going to help your taxes. It certainly will help your mortgage to get paid off quicker, which is also a great thing, but definitely a different thing.
Great. Thanks for the clarification.
You bet. All right, let's move on. So required minimum distributions. So if you are 72 years old and older in 2024, then you should listen up. Required minimum distributions, you should be aware of this. If you're not, this is where the IRS requires you to take money out of your IRA, 401k, SEP IRA, simple IRA, any kind of pre-tax retirement account. The IRS requires that we start taking money out of that starting at age 72. Now, the laws have changed a little bit. So if you're not 72 this year, you may want to reach out to us to find out when your date is, because for some people, it's now 73 years old, and for other people, it's actually 75 years old. But bottom line is, if you are subject to a required distribution, this does need to be done before the end of the year. There are some hefty penalties if you don't do it. And so we need to make sure that you do that. And this is just as easy as pulling some money out and claiming it as taxable income. That's what the IRS is requiring in this moment. So for a required distribution. And we'll talk about some different ways here in a minute that we can satisfy that distribution without it being a tax burden. But generally speaking, these required distributions are just that, they're required.
Great. So moving on to tax loss harvesting, and this is not, as most of the things we've talked about today do not apply to everyone every year, but just wanted to provide you with a list of things that you can look at and say, hey, I ought to take a look at that this year. Tax loss harvesting has to do with selling investments or other things that you might have had a loss on during the year. So let's say, for example, you sold a piece of property and you're trying to find a way to offset that. You could go through your portfolio with with our help, with an advisor's help, to say, hey, do I have something that we've owned that we could sell that would have a loss? And certainly you want to make sure that you're doing that for the right reasons. You don't want to sell something that you are going to regret, but we want to make sure that it's appropriate within your risk tolerance. But you can certainly take that loss, stay out of that for a certain period of time, 30 days plus one, and then be able to go back into that. But it's a process that is a little tricky, but something that we're very experienced with, and do this each and every year with some of our clients to make sure that they're taking advantage of that opportunity to go through the portfolio, highlight any of those investments that may not be performing, and to then go through the process and say, is this one that we could make a change on that would help maybe reduce some of our taxes by selling that before year end? And again, this is one that has to be done before 12/31 of each calendar year.
So Dan, one addition to that, think of this as an opportunistic arrow in your quiver. So let's say you sold some property this year in 2024, and you're going to get hammered on capital gains. Okay. Tax loss harvesting in most scenarios are offsetting long-term capital gains. There are some provisions for short-term capital gains, but there's a limit to that. So really, we're looking for long-term capital gains to offset with long-term capital losses. So say you sold a property you've owned for 20 years and you're realizing a large gain on it. This is where tax loss harvesting would be really valuable to you, to look inside of your portfolio and very intentionally consider if there's any losses that you could capture to help offset that larger gain that you have on your tax books for the year. The other neat thing with this is you don't have to miss the market to harvest a loss, right? We could sell Coke and buy Pepsi, and we're still in a US beverage company, and we don't miss the market for those 30 days that Dan mentioned. And then, a month later, if we want to go back to Coke, then we can, right? And so there's ways to do it. And as Dan said, it's a little bit nuanced. There's a little complexity to it. And we also want to make sure we're not letting the tax tail wag the dog, right? The goal is to make money here in the stock market, not to get losses to offset our taxes, right? But in certain moments, there's opportunities here if we're looking for them and taking advantage of them.
Yeah, let me just reiterate a little bit what Brian mentioned in that opportunistic scenario. If you do have a loss on something and you don't have capital gains, you're limited to how much of that you can write off. You don't, let's say you had 10,000 loss, you can only write off, I believe it's 3,500 or 3,000. I'd have to double check for sure. The remainder that carries forward. Not that you wouldn't want to do that, but this tax loss harvesting is something that you can take advantage in those years that you do have a sale of a piece of property or something else, and be able to harvest all of that 10,000 against that capital gain. So just keep that in mind.
Well, and the neat thing about this is if you don't use it, it does carry over, like he said. So the other opportunistic idea is when the market gives us an opportunity to tax loss harvest. In the last couple of years, in 2022, as well as in 2020, when we had COVID, we had a couple opportunities where we could tax loss harvest and bank some losses to offset against future gains. And so either the market would trigger this opportunity, or you would look for this opportunity to offset something else that happened in your world in reference to gains. And so just a nice arrow in the quiver, something to consider in a proactive tax planning and investment management type situation.
Why don't you go ahead and finish us off with QCDs and donor advised funds, Brian?
Perfect. So a QCD, or a qualified charitable distribution. So let's talk about this for a minute. So what this really is going back to our required minimum distribution. So if you need to take money out of your IRA, this is one way you can do it, which will satisfy the required distribution. Now, essentially what this is pick a charity, anyone that you would like, as long as it's a 501c3 that will accept a donation like this, and you're going to give this donation out of your IRA. So it goes directly from your IRA to that charity. And it doesn't matter if it's a church or a local charity or whatever it might be, but the benefit to this qualified charitable distribution is it satisfies the required distribution. It also is a non-taxable distribution. So you don't have to pay taxes on the money that goes out, which is a pretty neat thing. And then you also still get your deduction on a personal expense as a charitable deduction, right? So there's 3 benefits. You get the deduction, you get a non-taxable distribution from your IRA, and it satisfies the required distribution. So the age requirement for these QCDs is a little different. You can do this starting at age 70 and a half years old. So if you're older than 70 and a half and you're charitably inclined, meaning you're going to give to charity anyway, we want to be doing this out of your pre-tax retirement accounts, out of your IRAs, out of your 401ks. And so if you have questions about this, definitely reach out to us. We can help you do this. This is something that we do quite a bit.
So Brian, if on a yearly basis, I was giving $2,000 to Save the Sea Turtle Foundation, and my required minimum distribution was $4,000, how would that work in that case?
Yeah, great question. So in that situation, you could give $2,000 to the Save the Turtles. Is that what you said? Save the Turtles Foundation. Worthy cause. And you would still be required to pull out another $2,000 from your IRA. So that portion would be taxable, but then you're left with an opportunity, right? You can look at that and say, well, there's only 2 things I'm ever going to do with my money. I'm either going to spend it or I'm going to give it away. So this is an opportunity for you to decide, maybe we give $4,000 to the Save the Turtles Foundation, or maybe find another foundation we want to give the extra $2,000 to. And so if you wanted to do a QCD, or a qualified charitable distribution, with the full $4,000, you could do that and you wouldn't have to pay any taxes on that distribution, but it wouldn't be going to you to spend. So if you want to spend it, you got to take it through the tax gate and pay the tax on it as ordinary income. So that's kind of your option, or your opportunity to look at that. If you want to come home with some of it, great, but you'd have to claim it as taxable income. All right, so let's talk about donor advised funds in reference to charitable giving. So charitable deductions are a great opportunity to give charitably, to follow your heart in reference to things that you care about and want to give to, and there's some tax benefits to it. So if you want to give to charity and get a deduction, a couple things I would keep in mind. One, see if you're itemizing on your personal taxes or not. If you're not itemizing, then you might not be getting the full benefit of that deduction. So that's something to ask and talk to your accountant about. The other thing is, maybe you really want to give to charity from a tax perspective. In other words, you want some big deductions this year for whatever reason. Maybe you sold some equipment that was fully depreciated and you're getting killed on taxes from that transaction, or maybe you had a big year in revenue, whatever it is. If you know you want to use charitable giving to offset your taxable income, or offset your income, then you can give money to charity. Let's say you don't have a charity that you really want to contribute to. in the amount you're wanting to contribute. That's what a donor advised fund is for. So think of this like an investment account that you can throw money into. You don't own the money anymore. It's been given to charity, but you get the deduction in the year that you contribute it. Then you can invest that money and it can grow in your ability to give in the future. You don't get any further deductions from it. You take it in the year you contribute it, but you don't have to give it all to charity right now. You can give that to charity over time, or maybe have it go at death, that there's a giant bequest that goes to a charity of your choice. But it allows you to control the timing of the charitable giving and the timing of the charitable deduction in a little bit, with a little bit more intention. So donor advised funds, if you're not sure which charity to give it to, or maybe it's a larger number than you want to give to that particular charity that year, and then a charitable deduction if you're just wanting to give to a charitable scenario. All right, last thing, Roth conversions. So a Roth conversion is essentially where you're choosing on the timing of your pre-tax retirement accounts and pulling money out of them, right? So you can convert money from IRA to Roth anytime you want, okay? There's no penalties associated with it. You would just have to claim it as taxable income. So why would you do a Roth conversion? Well, I would say the main reason is, how do you want this money to grow? Would you prefer it to grow tax-free for the rest of your life? Then convert it to Roth, right? The downside to a Roth contribution is that it's not deductible, right? So maybe you took a deduction in the past and that was needed in the calendar year that you took it, but now you're in a position where you can realize that tax and let it grow tax-free moving forward. That's one reason you might consider a Roth conversion. Another reason would be to minimize your required distributions in your 70s, 80s, and 90s. We know that you have to start taking money out when you turn 72, 73, or 75, depending on your age. But if we have a large amount of pre-tax money that's grown over the years, your required distributions might be really large, maybe larger than you're comfortable giving to charity using a qualified charitable distribution. So with that being the case, we might intentionally, over a period of time leading up to age 72, 73, or 75, convert money from IRA to Roth at a very targeted tax bracket. So you might, if you're in the 12% tax bracket, maybe you just fill up the rest of the bracket with a conversion. Claim it as taxable income in that calendar year and let it grow tax-free the rest of your life. Maybe you're targeting the 22% or 24%. But generally speaking, you're doing it intentionally. You know this money is going to be taxed either in life or in death. And so we are essentially choosing the timing as to when we want it taxed and then letting it grow tax-free from that point forward. The other neat thing about a Roth conversion is that it also, once it's converted to Roth, will pass to your family tax-free in the Roth versus an IRA. Essentially the kids or the beneficiaries only have 10 years under today's tax law to unwind all of the taxable income inside of those IRAs. So this is partially a legacy play, partially an income tax play in your 70s, 80s, and 90s, but really it's just a timing thing. We know that we're going to have to pay tax on this either in life or death. When would we prefer to do it? Under current tax law, which are historically low tax brackets for another couple of years, or would we rather do it later? So Roth conversions are a very unique situation because everybody's tax environment's a little different, but definitely a conversation you should be having in the fourth quarter like we are in right now. All right, well, that's kind of what we had to talk about. I guess I need to stop sharing my screen here. So hopefully you got a little something out of that. Again, we talked about retirement contributions and reviewing your current tax withholdings. We talked about looking at educational expenses and make sure that you're choosing the timing of those wisely. 529s for college savings, health savings accounts for healthcare and out-of-pocket medical costs. Maximizing your business or personal expenses and really choosing the year that you want those deductions. Maybe it's this year. If so, do it before the end of the year. If not, maybe it's next year you're wanting to push some of those expenses, but think about that. Required distributions if you're in your 70s, tax loss harvesting, qualified charitable distributions, where you're paying your charitable giving out of your pre-tax retirement accounts like your IRA, and then Roth conversions, you know. So hopefully you got something out of this, just some great ideas of things to be considering as we roll into the end of the year. And, you know, because come January, February, March, now it's a function of accounting. We're accounting for what already happened. But at that point, we don't have any ability to change to a large degree what happened. So this quarter is really where we get to affect change. And so I'd invite you to think of these and other things, as well as I would always recommend reaching out to your accountant and having a quick conversation with them about how your year is shaping up, and consider any other potential ideas they have as well. So hopefully this was helpful. Feel free to reach out if you want any clarification as to anything we talked about and how it pertains to your situation. We'd be happy to help. So thanks for joining us today. I did want to announce next month's Elevánt Insights. So next month's Elevánt Insights will be on Friday, November 15th. And we are really excited about it because we're going to talk about mental health and money and mental health. You know, it's funny, we often joke with clients that sometimes we're a marriage counselor, sometimes we're a therapist when it comes to, you know, people sitting in these chairs and talking about money. There's a lot of emotion wrapped up in money. But what we're going to explore is the other side of that, actual therapy, actual couples therapy, and how money shows up in those environments. And so we have a mental health professional that's going to be joining us next month, who's a licensed therapist, both in the family and personal side of things, that is going to help us kind of talk about different aspects of how money shows up in our mental health, in our relationships with ourselves, and in our relationships with our significant others. So it'll be a fun one. We're excited to pick his brain and to really dive into that world of money and mental health. So we'll look forward to seeing you then. Don't forget to reach out to your accountant, reach out to us if we can help, and don't wait till the last minute, because then that's just overly stressful when you should be celebrating at the end of December. So thanks all. We appreciate the trust that you exercise in us every day. We do not take that lightly. We're constantly striving to be the best we can be for all of you, and that will remain every single day. So have a great October, and we'll see you next month.
Thank you all.